Hey everyone, welcome to the channel. I'm Rohit, and today, we're diving into some powerful financial tips that can help you take control of your money and set yourself up for success. Whether you're looking to save more, invest smarter, or simply get your finances in order, this video has something for you. Let's get started. So, today we're going to talk 5 easy steps to start investing. Starting to invest can feel overwhelming, but breaking it down into simple steps can make the process easier. Here are 5 easy steps to get started. 1. Set your financial goals. Why it matters. Before jumping into the world of investing, it's important to understand why you're doing it. Are you looking to grow wealth for long-term goals, like retirement? Or is it a shorter-term goal, such as buying a house or funding a child's education? How to do it. Clearly define your goals, and break them down by time frame. For instance, if you're saving for retirement in 30 years, your investment strategy might differ from someone saving for a down payment on a house in 5 years. Why it helps. Knowing your goals will inform your decisions about how aggressive or conservative your investments should be, and how you should structure your portfolio. For example, retirement investing can afford to be more aggressive, i.e., higher risk, higher potential reward, because you have decades to recover from any downturns. 2. Create an emergency fund. Why it matters. Before putting your money into investments that could fluctuate in value, you need to ensure that you can cover unexpected costs like medical bills, car repairs, or job loss. An emergency fund helps prevent you from needing to sell investments in a panic if something urgent comes up. How to do it. Save 3 to 6 months worth of living expenses in a savings account that's easily accessible. This fund should be separate from your investments, kept in a liquid account, like a high-yield savings account, and ideally, in a place where it earns some interest. Why it helps. Having an emergency fund provides peace of mind. Knowing you can cover unexpected expenses means you can invest with more confidence, without worrying about needing to access your invested funds too soon. 3. Understand your risk tolerance. Why it matters. Different investments come with different levels of risk. Some investments, like stocks, can provide high returns, but they can also lose value quickly. Others, like bonds or savings accounts, are more stable but tend to grow slower. How to do it. Assess how much risk you're comfortable taking on. Are you okay with large fluctuations in your investment's value in exchange for potentially higher returns, or would you prefer more predictable, stable growth with less risk? This depends on factors like your age, your financial goals, and your emotional comfort with risk. Why it helps. Knowing your risk tolerance will help you select the right investments for your situation. For example, if you're young and saving for retirement, you might be more willing to invest in riskier, growth-focused assets, like stocks. However, if you're nearing retirement, you may prefer safer, more conservative investments. 4. Choose an investment account. Why it matters. To start investing, you need an account that allows you to buy and sell investments. There are different types of accounts, depending on your goals and tax situation. How to do it. The most common accounts for individual investors are brokerage accounts. These are taxable accounts that give you access to a wide range of investment options, such as stocks, bonds, mutual funds, and ETFs. You pay taxes on the earnings, such as dividends and capital gains. Retirement accounts. Accounts like an IRA, individual retirement account, or 401k offer tax advantages for long-term retirement saving. A traditional IRA, for example, allows you to defer taxes on contributions until you withdraw the funds in retirement. Why it helps. The type of account you choose will impact your taxes, contribution limits, and when you can access your money. For instance, if you're investing for retirement, opening a 401k or IRA may be beneficial for the tax advantages they offer. 5. Start with low-cost, diversified investments. Why it matters. For beginners, picking individual stocks can be intimidating, and it also requires a lot of time and research to do effectively. Instead, investing in diversified assets, like exchange-traded funds, ETFs, or index funds, can provide exposure to a broad array of companies and industries, reducing the risk of any one investment underperforming. How to do it. ETFs, exchange-traded funds. These are baskets of stocks, bonds, or other assets, which you can buy or sell like a single stock. They're usually low cost and allow you to invest in entire sectors or markets without needing to pick individual companies. Index funds. These are similar to ETFs, but they're typically structured as mutual funds. They track a specific market index, like the S&P 500, and are designed to mirror the overall market's performance. Why it helps? By choosing low-cost, diversified investments, you spread your risk across many different assets, which minimizes the potential for large losses. Index funds and ETFs are often a go-to option for beginners because they require little maintenance and tend to have lower fees than actively managed funds. By following these steps and staying consistent with your contributions, you can build wealth over time. Remember, investing is a long-term game, so patience and discipline are key to success. Remember, it's all about starting small and being consistent. Your financial journey doesn't happen overnight, but with the right steps and mindset, you can make incredible progress. If you like this video, give it a thumbs up, and don't forget to subscribe for more content like this. Stay smart with your money, and see you soon.